Hello, and welcome to another 30-Minute Thursday. My name is Amit, and God willing, we are live on Facebook. I hope you guys are doing great. I hope everybody is staying safe, staying healthy, staying sane. Always important to stay sane, of course. And I am dealing with technology issues here in my home studio. I'm not in the luscious New American Funding Studios, so I'm just trying to work with my son and with the room, the lighting, the what have you. It's a beautiful day here in the Pacific Northwest. We are in the middle of winter and it's cold. It snowed overnight last night, didn't stick, of course, but it is really nice and sunny. And as a result of that, I'm getting all sorts of weird sort of reflection and light and all the rest of that stuff. So I'm trying to work with my my remote control blinds here, which I really love. My wife insisted that we buy these when we moved into the house, and like many of the other things, she is a lot smarter than I am about these things. And look at that, we're just creating a much better studio here as we work. So how's everybody doing? Happy Thursday, happy tail end to February, I hope. I got to tell you, I am super excited. I just got a text message from the gentleman with whom I buy, or from whom I buy my beef. My rancher is on his way over the mountain passes, weather permitting, of course, with a side of beef. That's half of a steer, basically, that me and another family is going to split. So tonight, I hope to get several 100 pounds of beef, and I'm really excited about that. You guys know I love to eat beef, I love to cook, I love to grill, I love to cast iron skillet. All of it makes me very, very happy, and I'm super excited to be on the receiving end of this wonderful delivery. So fingers crossed that the weather is accommodating, and soon enough I will see my beef purveyor, and then I'll be posting more Facebook photos of fabulous steaks and other meals. Anyway, that said, let's just jump right into what's going on with inflation, what's going on with the Fed, what's going on with the economy, with the housing market, with interest rates, with all of the above, and then some. So tomorrow is going to be a really big day. And I hope it's going to be a good day. But tomorrow we're going to see the Fed's favorite measure of inflation, and they call that the shorthand for it is PCE. Personal consumption expenditures. Sounds very governmental, sounds very like, what exactly does that mean? Personal consumption expenditures. Basically, it measures the cost of things, and there are different components that go into this measuring metric. The Fed and the economists that generate these numbers look at a variety of different components of things that people like you and I spend our money on. And they come up with a measuring system for it, and then they come up with a tabulation system for it. And that gets reported every month for the month previously. So it's always backward looking. It takes time. First of all, you have to wait for the month to end. Then it takes some time to gather all that data and do all the math and the number crunching and present it with I don't know what the heck that was. That was an interesting pop. But in any event, it's going to take a little bit of time. So this is for the month of January. So it's backward looking data, but fingers crossed that we're going to see a good number on this report, as opposed to what happened on the Consumer Price Index report, which is another measure of inflation that came out like a couple of weeks ago. The Consumer Price Index was not very helpful for us. And by that, I mean that it was very impactful on interest rates and the markets, but not a good impact. And one of the main reasons is because the CPI, the Consumer Price Index, has different measuring or different, what's the word I'm looking for here? Different values that they use for different components. So for example, the cost of shelter in the Consumer Price Index is at 43% of the overall number for the monthly CPI report. So 43%, let's call it 2/5 of the entire value of that report is made up by this one component. And this one component happens to be really, really sticky and really, really tricky, because one of the things that they measure in shelter costs is rental contracts, rental agreements, lease costs. How much does it cost to lease the home that you live in? Well, people don't sign a lease every month, right? I mean, you renew the lease usually once a year, and then you ride that out. And it's kind of a very difficult number to just get your arms wrapped around in the first place. But on top of that, it's really backward looking, because some of these leases may have been entered into, 6 months ago, 8 months ago, whatever it is, and they're still tabulating them in real time, so to speak. So the PCE, the personal consumption expenditures, good grief, some of these terms, I'm sorry guys, but the PCE has a much lower weighting on the value of shelter costs. So the PCE is basically 20% of the total, which is half of the measure used for the CPI, the Consumer Price Index. So we're hoping, knock on wood, that we're going to see a good number, a better number, a number that's going to be more appreciated by the markets, and we will see mortgage interest rates come back down. Because I'll be perfectly frank with you, over the last 3 weeks since the start of February, they've been going up and up and up. And that's really frightening, and it's really frustrating for home buyers who are just trying to get a sense of, what can I really expect? What am I really qualified for? How much should I expect to pay on my monthly payments? What are the expectations for my qualifications for being pre-approved? We like to see things in general be consistent, right? We want to see things in general not be very volatile, where one month it's up this high and then it's down here and then it's up again, and that makes it really difficult for anybody to kind of put their arms around, where am I? Well, what are my expectations? And over the last 3 weeks since the start of this month of February, we've just seen interest rates going up by 0.75% on the 30-year fixed. That is a shocking number. I'm not going to kid you. I don't know what else to say. It's been really fast. It's been really unpredictable. And it's, in my opinion, an overdoing of things. And the markets, they do things the way they do things. The markets are made up of people. People are irrational. And there's a saying, an old saying that goes, basically, the markets can remain irrational longer than you can remain solvent, which basically means you can't argue with these things. They just are the force of the economy or the markets as they are. You may be right, and you may still lose if you're betting on one outcome or another. So we have to roll with the punches. We have to take what the markets are giving. We have to be very cautious with our timing, of course, and try to predict as much as possible. But the good news is that big picture, really big picture, relief is coming. I don't know if that's going to happen starting this coming tomorrow or next week or next month or 8 months from now. But big picture, the relief is going to get here. Right now, if you're buying a home, and you're getting into contract today or tomorrow or later on next week, that might be a little bit of a jagged pill to swallow, because the rates may not be as great as they will be in 3 months. But we can refinance. And that's the good news as well. These things are not permanent. They will pass, and we will get to a place where things are going to be better on the interest rate environment. This I'm very confident of. I cannot tell you exactly when, but that's coming. And the reason it's coming is for all the things that we've been talking about. The Fed continues to raise interest rates. In fact, there are talks that the Fed is going to raise their rates yet again at the March 14th meeting. I hope they do. I'll be perfectly frank with you guys. The reason I hope they do, and this is really going to mess with your head, this is counterintuitive, but the reason I hope the Fed raises their interest rates is because that activity is designed to fight inflation. I know it's counterintuitive, but Fed rate goes up, mortgage interest rates tend to come down. I'll do it this way, right? Fed rate up, mortgage rates down. Why? How does that work? It just doesn't make sense, right? And the reason is because what the Fed is trying to do is to cause people to stop spending money that they don't need to spend. And I know that sounds really weird. Like, what is the Fed my dad? Is the Fed my parents saying, hey, you need to budget better, you need to spend less money on going out, you need to spend less money on beef, you need to spend less money on other things? To a certain degree, yes. The short answer, the playful answer is yes. The Fed is taking the role of parent or caretaker of this economy, which is really unfortunate because they had that role a year ago and 2 years ago, and forever they've had that role, and they've been pretty absent about their guidance and about shepherding the economy. They allowed inflation to get to the point that it is right now. So, now all of a sudden, now they want to get serious about dealing with inflation. That's kind of a weird thing for me. But yes, the Fed is taking the role of parent figure here, and they're trying to shepherd the economy into a disinflationary sort of position, meaning that they want to see the cost of things come down. And when the cost of things comes down, then the rate of inflation also comes down. Okay, that's great. How do you bring the cost of things down? Well, supply and demand, right? There's basic laws of economics where it says basically if there's no supply and a lot of demand for that very limited supply, think Taylor Swift concert tickets, the price is going to shoot up, right? I'm not a huge fan of Taylor Swift's music, but I know what the concert tickets cost, right? So no supply, lots of demand, price goes up. Lots of supply, no demand, price comes down. And that's what they're trying to do through the Fed. And so the only way they can do that is by making it really expensive for us to borrow money on the short term. On the short term, that's the most important part of that. Short-term loans. So your credit card is going to go up. If you carry a balance on your credit cards, every time the Fed raises those interest rates, the credit card costs go up as well. And the idea behind it is, it may not sound very nice, and it certainly doesn't sound very, very helpful for people who are struggling with credit card debt. But the idea behind this is, hey, if it becomes so expensive to make your minimum monthly payments on your credit cards, and you get to that point where you're tapped out, then you're going to stop spending money. And when you stop spending money and there's still supply in the marketplace, they've got plenty of shirts and plenty of shoes and plenty of handbags and plenty of whatever other things, they're going to start pricing those items lower and lower and lower to get to the point where you are comfortable spending the money to buy them. And as those prices come down, the way they measure inflation is going to reflect that prices are coming down, which means the rate of inflation comes down. And then the economy gets to that equilibrium that the Fed wants, where they've got roughly 2% rate of inflation year over year. Right now, we're at 6%, down from 8%. So yay, they've done a great job, but they let it get to 4 times what their actual number should be. Their number is 2%. And they let it get to 8%, maybe even higher. So they totally dropped the ball, and now they're trying to fix that mistake. And the concern is that they may overcorrect along the way. So right now, they're talking about, hey, we may need to raise our interest rates on the short-term money by another 0.5%. That the market is starting to talk about that as a possibility. Right now, there's a very, very strong likelihood that the Fed is going to raise their rates in March by another 25%, or 1/4%, I'm sorry, 1/4%, 25 basis points. But they may actually raise it by 0.5%. Just depends on what comes out tomorrow in the PCE, the personal consumption expenditures number. If that number comes in hotter than they think, meaning higher inflation, not lower inflation, that's going to be a problem. And they're going to have to take stronger corrective measures, meaning that they're going to have to raise their interest rates even higher. And that's going to make the cost of borrowing money on our credit cards and maintaining a balance it's going to be that much higher. It's going to make your home equity line of credit costs go up as well. Any sort of short-term variable loan that we have is going to be impacted by the Fed raising their rates. But big picture, the mortgage interest rates that home buyers are looking at right now, or that home buyers got into last month, last year, that sort of thing, they will come down as the Fed continues to raise their interest rates. I know that's really counterintuitive, but that's a big part of the picture. The other part of the picture is employment. And this is actually what started the whole thing in the beginning of the month, meaning what started the interest rates to go up and the economy to be taking a U-turn from the positive direction we were going in. On February 3rd, there was an unemployment report or a jobs report that came out. And keep in mind, now the Fed wants to see unemployment go up. I know that, again, that sounds very cruel, and I certainly don't want to see anybody lose their job and certainly don't want to see anyone in economic hardship. But that's what the Fed is trying to create. They've actually said it. They need to see the rate of unemployment going up. And as the rate of unemployment goes up, guess what happens? Spending slows down. People who are afraid of losing their jobs, or people who have in fact lost their jobs, they do not spend money on vacations. They do not spend money on things they don't absolutely need. And so they're going to tighten their belt. And as they tighten their belt, the people around them who are thinking about changing jobs suddenly decide, I don't want to rock my boat either right now. I don't want to create a situation where I might lose my job or where I might not have as good a benefit of making a change. So employers, when unemployment rate goes up, they start making concessions, or internally they stop paying people as much, right? When the labor market is tight, let's look at it this way. Sorry, I'm not stating it very well right now, but I'm going to fix that in this. Right now, I'm going to fix that. When the labor market is tight, when unemployment is really, really low, and you as a company need to attract talent, the way you do that is by offering them more money. It's just that simple. We'll pay you, a higher rate than what you're getting at your current job. We'll pay you a bonus to just join our company and pay you higher wages. We'll do all sorts of things to attract talent because we need help. We need people to work for us, and the market for employment is really tight. And so we've got to attract talent. The exact same thing is true in reverse as well. When unemployment goes up and people are looking for jobs, they're willing to take slightly less income. They're willing to not ask for a signing bonus or other sorts of money to entice them to come back to the workforce. And so the Fed wants to see unemployment rates go up because they know that as that happens, income and discretionary income is going to come down. Once again, when we have less money in our pocket, we're less inclined to spend it on things. And as the sellers of these things need to move their inventory, they're going to make them less expensive, less expensive, less expensive, until we find that equilibrium where people will say, you know what, I'll buy it at that price. And that is how the Fed wants to bring down the rate of inflation. Again, so in February 3rd, we had this huge jobs number that came out for the month of January, and it made it seem like we had 500,000 new jobs created. That wasn't really true. That wasn't accurate. But the markets treated it as accurate. And let me tell you why I say the markets are made up of people. That's true to a very, very certain degree. That is true. People make the markets, but trading decisions are now being done at the biggest brokerages, the biggest, the BlackRocks and the JP Morgans and like the Goldman Sachs of the world. They trade with algorithms. It's a computer decision to trade, to buy something or to sell something in the markets. And they get triggered in a nanosecond based on data that comes in. And so the second that algorithm picks up this data, favorable jobs report, bad for inflation, bad for the economy, we're going to do this. And it just executes a trade very, very quickly. Later on, the people behind all that sift through all these pages of data, all this information, all the notes that go into the reports that are released, and you find out, oh, well, you're counting things for this unemployment number in a really weird way that you've never done before, and it's a one-time a year sort of adjustment, and you made that adjustment. What happens next month, right? So next month, actually March 10th, we're going to get the unemployment report for February. And we'll see. Now, again, I don't want to see people suffer. I don't want to see people lose their jobs. I don't want to see people in economic hardship or distress, but we're going to see possibly a much lower employment number, a much higher unemployment number. And once again, that is good for inflation. Not great if you're losing your job. I completely sympathize. But on the big picture, that's what the Fed is looking at. And those are the telltale signs that we're looking at, the tea leaves, as we say, to figure out what are they going to do? What is actually happening with the economy? They've laid out the game plan. They're going to make the cost of money so expensive that people basically stop spending it. And as that happens, people are going to get laid off because companies are like people. They're also going to stop spending money. They're going to cut unnecessary staff, right? They're going to lay people off. They're going to not make those big capital improvements. They're not going to go after that shiny new project. They're going to wait till they can borrow money at a cheaper cost. Just like people right now are waiting to buy houses and borrow money at a cheaper cost, right? I mean, all of this is related. So the Fed has shared with us their blueprint, and now we're looking at these reports. They've put the blueprint into action, and now we're looking at these reports to see how we've done. I mentioned to you guys, sorry, I'm just looking at the time. I mentioned to you guys that I like to cook. I do. I love to cook. I love to eat. I mean, I really love to eat. What I don't like is to do the dishes, but I'm pretty good at that as well. I can kind of fit things into the dishwasher better than most because I've got kind of that weird brain for that. But going back to cooking real quick, when we cook, when we run a recipe, we season to taste, right? At least I do. Now, I don't do things with, really clearly defined recipes, half a tablespoon of this, 3 teaspoons of that. Like I don't do that, but I season to taste. And the Fed is doing the same thing with their raising of their short-term interest rates. They're seasoning to taste. How do they taste what's going on in the economy? They look at these reports. That's exactly what they look at. They look at personal consumption expenditure reports. They look at consumer price index reports. They look at the unemployment report. That's my dishwasher going off. Sorry, I wasn't expecting to do this from home. And so, yes, there are some things happening. That beep is the dishwasher telling me that it's finished. But the Fed is looking at these things as a way of tasting the recipe and seeing what needs to be added. They don't just pour the entire bucket of salt in there. They pour some of that in there, and then they wait and see, is that too salty? Is that salty enough? Do I need to add a little bit more? Do I need to reduce it? That's what they're doing with these reports. So to recap, we have had a really, really rough February. Up until the last couple of days, thank goodness for that. A little bit of a relief. The markets are kind of taking a breather right now. Interest rates on mortgages have gone up, though, since the start of this month. There's no denying that. There's no escaping that right now. Good news is, though, that we're hoping that we're going to see some better numbers starting tomorrow with economic data, inflationary readings, unemployment readings in a couple of weeks. That's March 10th. So, we've got a few things, and then the Fed meets on March 14th. So, and they're going to make decisions based on these past numbers, what they plan to do at their March 14th meeting. Right now, they're thinking a quarter of 1% increase. So 25 basis points, quarter of 1%. However, there are some of the Fed members who are talking about raising that interest rate by 0.5%. We shall see what happens. But whatever is happening in that sort of conversation, I think that we're going to see higher interest rates by the Fed. I think this inflation is a little bit stickier than they thought. I think that we've got other things going on that are not really representative of the economy, but it still creates kind of inflationary pressure. I'll give you one, for instance, making a lot of these cash donations to the country Ukraine. that's expensive. Whatever your politics are, it's not really relevant here. But when we give money and give money and give money to other countries, someone's got to pay for that. And that creates, again, inflationary pressures. So we'll see what happens. I think big picture, though, really big picture, in the next several months, in the next year, we're going to see inflation come way down. And that is really exciting. Right now, doesn't feel great. But look ahead for the next month, look ahead to the next 6 months. Let's see where things go. I'm going to continue to give you guys all the information I can. I try not to sugarcoat it. I try to be very respectful of people's opinions, very respectful of people's positions. I certainly don't want to see anybody lose their jobs. That doesn't make me happy in any capacity. You know, there's an old joke about that. It's not really funny, but it's very, very applicable. When your neighbor loses their job, it's a recession. When you lose your job, it's a depression. It is absolutely terrifying to see things happening in this economy by design, intended to bring the rate of inflation down. But we're seeing that, and hopefully it does the job and we get through this sooner rather than later. But good things are coming. It's just a matter of time, and I will be here every week, ideally, to share with you what's going on, to give you my opinions, and to give you some expectations of what to look for in the coming days and weeks. So with that said, we are almost at time. I can't believe how quickly these 30 minutes go. I'm going to go get my freezer ready to onboard all of this beef that's coming. I am going to wish you guys a very wonderful day. If you happen to be in the Pacific Northwest, in the glorious, sunny, yet cold Pacific Northwest, I highly recommend you get out there and enjoy some of this beautiful sunshine. It will start raining again soon enough. And wherever you are, I hope you're staying safe. I hope you're staying healthy, of course, staying sane. And I look forward to seeing you next Thursday. Thank you guys so much for spending a little bit of time with me today. Y'all take care. Peace.